Imagine walking into a room where every single person is wearing a designer suit, driving a luxury car, and living in a mansion. Yet every single one of them also has a maxed out credit card and is desperately borrowing from their neighbor just to pay the interest on their last loan. This is the strange, contradictory reality of our global economy in 2026, where we are simultaneously wealthier than we have ever been in human history and buried under a mountain of debt so high it could reach the moon and back 50 times. To understand how we got here, we have to look past the scary headlines and analyze the world not as a collection of countries, but as one massive, interconnected balance sheet. We are currently sitting on a global net worth of approximately $600 trillion, which breaks down to about $75,000 for every person on the planet. This sounds like an incredible success story, especially considering our collective wealth has nearly doubled in just the last decade. However, while our wealth is skyrocketing, our actual productivity, the goods and services we actually create, measured by GDP, has only grown by a modest 40% in that same time frame. This massive divergence between what we think we are worth and what we actually do is the most significant economic puzzle of our time. To grasp why this gap matters, think of the global economy like a high-end boutique coffee roastery. If the roastery brings in $200,000 a year in sales, its personal GDP looks fantastic, suggesting a humming, productive business. But if you look at the balance sheet, you might find the owner has no savings and $1 million in debt used to buy the building and fancy espresso machines. The sales, GDP, tell you about the flow of activity, but the balance sheet, net worth, tells you about the actual financial health and stability of the operation. For decades, we only looked at the sales figures, but now the world's balance sheet is becoming too distorted to ignore. The global net worth now sits at over 5 times the global GDP, a figure that is 50% higher than the historical average. This means we are getting rich much faster than we are getting productive, and that is a major cause for concern. The engine driving this bizarre reality is debt, which has ballooned to a staggering $300 trillion, roughly triple the size of the entire global economy. When we hear that the United States is $36 trillion in debt, we often imagine a shadowy lender or a foreign adversary like China holding all the cards. But the reality is far more circular. China itself is drowning in over $18 trillion of its own debt. In fact, the world's debt isn't a pile of unpaid bills waiting for a collector. It's an interconnected web of promises where everyone is borrowing and lending to each other at the same time. If you live in the U.S., about 70% of that $36 trillion national debt is actually owed to Americans themselves. When you put money in a local bank, that bank doesn't let it sit in a vault. They use your savings to buy government bonds, which are essentially IOUs from the state. Your retirement pension fund likely does the same, investing a quarter of its capital into these safe government promises. This creates a self-reinforcing loop where your savings become the government's spending money. The government spends that money on infrastructure or social programs, which flows back into the economy, ends up back in banks, and is then used to buy even more bonds. It is a never-ending cycle of motion. On a global scale, it's even more entangled. Japanese citizens' savings might become loans for the Dutch, which then fund projects in Brazil, which eventually flow back into American Treasury bonds. This debt isn't just a problem. It is the very pillar upon which the modern economy is built. It fuels growth by allowing us to borrow from tomorrow to solve the problems of today. In countries like the US and China, roughly 1 out of every $4 or $5 spent by the government is actually borrowed money. If this borrowing suddenly stopped, the feedback loop would turn upside down, leading to business failures, mass unemployment, and economic collapse. Much like what happened to Greece in 2008 when their GDP shrank by 25% because investors stopped lending. So, if we were using all this debt to grow, why isn't our productivity keeping up with our wealth? The answer lies in what we are actually buying with all that borrowed money. Ideally, Debt should be used for productive investment like a graphic designer borrowing money to buy a high-end AI power drawing tablet that allows them to finish 3 times as many projects as they could with a standard mouse. In this case, the tablet, increases productivity, GDP. But that is not what is happening globally. Instead of buying shovels or tablets to work faster, we're using debt to bid up the prices of things we already own. A staggering 75% of the increase in global net worth since the year 2000 has been driven by simple price increases, not by creating new value or making things more efficiently. To visualize this, imagine a community of collectors who trade limited edition vintage sneakers. If one person sells a pair for $1,000, every other person in the community who owns that same pair suddenly feels $1,000 wealthier, even though they haven't produced anything new. If a newcomer enters and offers $2,000 for a pair just because they have extra cash from a stimulus check, everyone's net worth suddenly doubles. On paper, the community is now twice as rich, but they still have the same number of shoes. This is exactly what has happened with global real estate, which now accounts for a massive 2/3 of all humanity's tangible wealth. We are creating paper wealth by watching our house prices triple while our actual ability to produce goods and services barely moves. In the last 25 years, the world has created $35 of this paper wealth for every $1 of actual net investment. This paper wealth creates a dangerous incentive structure. When the value of a house or a stock grows faster than the profit from running a real business, people stop investing in productive ideas and start chasing asset appreciation. Even large corporations have fallen into this trap. Instead of using their profits to invent new tools or train workers, many companies are using their cash to buy back their own shares. In 2025 alone, corporations spent over $1 trillion on share buybacks, which serves no purpose other than to bid up their own stock prices and make shareholders feel wealthier on paper. It is wealth creating more wealth, rather than wealth creating more productivity. The danger of a system built on paper wealth and endless borrowing is that it eventually requires a reset if the underlying reality doesn't catch up. We saw a preview of this in Japan in the 1990s, where a massive asset bubble burst, leading to decades of stagnation and a painful balance sheet recession. When people suddenly realize their shiny rocks or vintage sneakers aren't actually worth the inflated market price, they try to sell all at once. But because there are more assets chasing fewer real dollars, prices plummet and trillions of dollars in paper wealth simply vaporize. For a world burdened by $300 trillion in debt, this is a nightmare scenario. If the value of your assets drops while your debt stays the same, you find yourself underwater, forced to cut spending and sell even more assets just to survive, which only makes the crash worse. This fragility is why we see a massive flight toward real assets like gold and silver today. In 2025, gold prices soared by nearly 28% because people were looking for something that couldn't be printed away or vaporized in a market crash. When governments find themselves unable to pay back their old debts, they often resort to printing more money, which leads to inflation. We saw the extreme version of this in Venezuela, where printing money to cover debt caused prices to double every few weeks, turning life savings into worthless paper. While most developed nations aren't there yet, the risk of moderate inflation shrinking the value of our savings is a constant pressure. How do we fix a $600 trillion problem? The most optimistic path is to find a way to make our productivity, GDP, grow fast enough to catch up to our inflated balance sheets. This is where the hope for an AI-driven productivity boom comes in. If new technology can actually make us 3 or 4 times more efficient at creating value, the way the shovel helped the man dig more holes, then we might be able to grow our way out of this trap. But technology alone might not be enough. We likely need structural changes to how we treat wealth. Currently, we have a system that often subsidizes hoarding unproductive assets while taxing productive work. One solution economists suggest is a shift toward land value taxes. Unlike traditional property taxes, which can actually discourage someone from improving a building, a land value tax stays the same regardless of what you build on it. This would incentivize people to actually develop their land and put it to productive use rather than just sitting on it and waiting for the price to go up. Similarly, things like vacant property levies could stop investors from treating housing as a store of value and return it to its productive use as a place for people to live. The goal of such taxes isn't just to raise money for governments, but to change incentives, pushing people to take their capital out of unproductive paper wealth and invest it back into the real economy. Just as a 2% inflation target is designed to keep people from hiding their cash under a mattress. Ultimately, the story of global debt and net worth is a story about trust and the promises we make to our future selves. Since 1971, when President Nixon ended the gold standard, our money has been backed by nothing but government decree and the collective belief that the system will keep moving. We have built a world where debt is the engine of progress, but we have forgotten that an engine needs fuel, actual, productive value to keep running. If we continue to prioritize asset price appreciation over real innovation, we have to ask ourselves, are we actually any wealthier today than we were 20 years ago, or are we just better at convincing ourselves that our shiny rocks are worth more? The $600 trillion question isn't whether we can keep borrowing, but whether we can finally start producing enough to make those promises real. If we can't bridge the gap between our paper wealth and our actual productivity, the global balance sheet reset may be an inevitable and very painful reality. If you made it this far, you now realize that the $300 trillion debt mountain and the $600 trillion in paper wealth we've discussed aren't just abstract numbers. They're the very foundation of the world we live in. We're at a point where our collective net worth is growing 5 times faster than our actual productivity. And as we've seen, that gap can only be filled by promises and debt. Whether we're heading toward a massive balance sheet reset like Japan saw in the 90s, or we're on the verge of an AI-driven productivity boom that finally lets our GDP catch up to our valuations. One thing is certain, the global economy is becoming more complex every day. Most people, and certainly most politicians, would rather avoid looking at these uncomfortable balance sheets. But understanding the difference between real value and shiny rocks is the only way to navigate what's coming next. If you found this deep dive into the hidden mechanics of global wealth helpful, hit that subscribe button and turn on notifications. We're going to keep tracking these trends from the flight toward gold and silver as the system becomes more fragile, to the structural shifts like land value taxes that could redefine how we invest in our future. Don't let your understanding of the economy be limited to just the income statement of GDP. Stick with us to see the full global balance sheet. Drop a comment below. Do you think our $600 trillion in wealth is a sign of progress, or are we just living in a massive bubble of paper promises? Thanks for watching, and I'll see you in the next one.